and I'm basically training it to be my clerk or my trading assistant. And it is very good at a few things, but it is not quite up to snuff yet on some other things. And in this video, I'm going to show an example of what I mean by areas where, for the time being, Chatgpt is weak. However, it's going to get better, and it's just a matter of time. Let's take a look. All right, so let's say that you have 50 shares of a stock, and the one I'm going to use is CBOE. So I have 50 shares of CBOE, and I want to turn it into a synthetic straddle. Let's see if ChatGPT can help out. $216 per share. All right. How can I convert into a synthetic All right, so here we go. I bought 50 shares of 216 a share. How can I convert this position, current position, into a synthetic straddle? So I want to hedge off the risk to the downside. And what this trade does is, rather than make it directional, it turns it into a vol trade. All right, let's see what we have here. And I'm just going to read what my assistant wrote. You're currently long 50 shares of CBOE at 216 with the stock trading at 231.71. You're sitting on a profit of about $15.71 per share. Perfect. To convert your long stock position into a synthetic straddle, you'll need to use options to replicate the risk-reward profile of a real straddle. Correct. Which involves holding both a call and a put at the same strike, typically at the money. Okay, not bad. Here's how you do it. Step one, sell your 50 shares of stock. You're going to offset your stock position with options. So we first assume you liquidate the stock to reset. Incorrect. I'm not going to do that. Buy one at the money put and sell one at the money call. Result, you have long stock plus long put plus short call equals a synthetic straddle. So step one, you're going to offset your stock position with options. Yeah, I'm not going to do that. So that's not going to work. Buying a put will help. And step three, sell one at the money call. So this would leave me short. Okay, this is another way to do it, but I would not do it this way. And the reason is selling the stock would not be the correct thing to do here, because that would basically leave me flat the stock, and then I'd have a put and a short call, a long put and a short call, which would leave me short, synthetically short the stock, which is not correct. So let me, before I get back to this, let me show you why that is not correct. And as an example, I used what I actually have here. Let me do my CBOE. Okay, so on the 17th of March, actually this was probably April, but either way, I have 50 shares of CBOE that I bought at 216 a share, so my outlay was $10,800. On May the 7th, I decided to turn this into a vol play. So I bought a put at the 230 strike, which expires May the 16th. So I have an expiration coming up soon, May the 16th. And this put cost me, with commissions, $166.13. So I paid $1.65 times the multiplier of 100. Cost me $166.13. So if we take a look at what I have here, this is just a P&L calculator, which I put together on the fly. Maybe Chatgpt can do this for me one day. But anyway, in column N, I just put the price of the stock that I paid in as the strike, and contracts I used 50. So think of it as, it's a little weird, but think of it as buying an option and paying a premium of 0. You got the 50 shares. Here, the rest of this column just calculates the value of my 50 shares versus the market at various prices in the market. So at a price of 200 for the underlying, I'm down $16 on 50 shares. 16 times 5 is 80, 800 for the 100 shares, so forth and so on. I start to make a little money above 216. Now for the put, same thing here. This is just a max function. So the cost of the put was 166.13 plus the max of the strike price minus the underlying, and then that'll give me a total value, actually P&L, for the option at the corresponding prices. So at an underlying of 200, there's my profit. So it's 30 times 100 minus the $166.13, and I calculate it on down, known at prices of 230 or above, I lose the cost of the put. And this column has the net. So it basically nets out this, and then it does it for the corresponding columns on the way down. So the important thing to note here is that at 230, okay, my worst case scenario now, because I bought the put, is $533.87. And again, this is at expiration. So let's keep that in mind. When the option expires, then the situation changes. If I still have the 50 shares of stock, then I have a risk on 50 shares of stock. But anyway, note that since it's just 50 shares of stock, so let me isolate this. And if I had 50 shares of, I originally had 50 shares of stock. So the risk graph looks like the following. So it's just basically a straight line from lower left to upper right. And for every dollar that the share price increases, I gain $50. And this goes all the way down. So think of this line as, without this put option here, is going all the way down, and that represents the risk that I have on 50 shares. However, when I purchase a put at $50 at the 230 strike, note that this gives me the right to sell 100 shares of SIBO at 230, should I choose to, on or before expiration. So if you think about it this way, let's look at the stock. Let's isolate the stock mentally. We have 50 shares, and for every dollar that it goes down, we're losing $50. Think of it down here, we're losing $50. However, since we have the right to sell 50 shares, sell 100 shares at a price of 230, there's an extra 50 here, because 100 minus the 50 shares of stock leaves me short 50. So this synthetic straddle, I'm long the 50 shares of stock. I'm long the put, one contract, which represents 100 shares, leaves me to the downside from 230 and below, net short 50 shares. So now I no longer care about, I no longer have directional risk. I no longer care where it goes, as long as it goes away from here. It's like having a dinner guest or someone over and it's late. It's like, wow, can you believe the time? Which basically means I want you to go as far away as possible from here where we are. So go either direction, doesn't matter to me. All right, getting back to Chatgpt. This is incorrect, and this is going to cause problems. Now, if you don't have the knowledge base to understand why this is a problem, if someone just followed what ChatGPT said to do here, you'd find yourself basically synthetically short 100 shares of CBOE, and you could get yourself in a lot of trouble. So no, we're not long the stock here. We're not long the stock. This is incorrect. This position behaves like a long straddle. It profits from volatility, but you'll still retain your stock position. And really, this is, unless I'm missing something, what could I possibly be missing? No, because you're long 50 shares, we sell 50 shares, you're flat, and then you're long and put, and short a call, you're synthetically short stock. So for now, AI ChatGPT has this wrong. Now, when will it be right? I don't know. I would imagine soon, actually. But my point is, other than it's still a few blocks behind the parade, ChatGPT is, it will catch up and eventually will be very, very handy. Let's say, for example, that your uncle dies and he leaves you whatever, 1,000 shares of Apple. You're not sure when you're going to receive it, but you don't want to, you kind of want to lock in current profits because your uncle was smart and he bought Apple 35 years ago. Let's say he bought it in 1990. So that 1,000 shares is worth a ton. You're getting it soon. Could be next week. It could be in 6 months. But you don't want to lose. So what do? There are a few things you could do. If you have the money, you could sell 1,000 shares short and lock it in right there. Let's see what ChatGPT says. 1,000 shares of Apple stock. How can I protect myself? All right, let's see what they come up with. Gives you a valuable asset. Yeah, I agree. That's right. But depending on your goals, it may be smart to hedge against downside risk. I agree, especially if you're concerned about market volatility or pullback in tech. Here are several hedging strategies ranked by protection level, cost, and complexity. Wow, it sounds good. Let's see what happens. Buy protective puts, best for full downside hedge, but quite expensive. How it works. Buy put options on Apple, typically 1 contract per 100 shares, so you need 10 contracts. All right, that's correct. Technically speaking, what it does, that is correct. Moderate to high, that is correct. Okay, so I did mention that it's expensive, and it does mention that it's moderate to high in terms of cost. Protection level, cost, and complexity. All right, I like the way it covers it. That's pretty good. Put spread, cheaper hedge. That's 100% correct. It explains how it works. Let's see, buy 10 puts at a higher strike. Example 180, sell 10 puts at a lower strike. That's good. What it does, caps your protection range but reduces your cost lower than buying straight puts. That's 100% correct. That's pretty good. Covered calls, offset downside with income. How it works, sell 10 Apple call options. What it does, earns premium income which can offset losses if Apple falls. Okay. Limits the upside, you may have to sell shares if Apple rises above the strike. Okay. Personally, I would not do this, but this is correct. And collar strategy. Ooh, look at this. Zero cost hedge. I like it. Combine a covered call and a protective put. Buy 10 puts, sell 10 calls. What is it? Protects against downside while limiting upside. Often low or zero net premium. I have to say that this advice so far is spot on and it's pretty good. ETF hedge. Look at this. This is interesting. Broader market risk. If you're worried about systemic risk, not just Apple, consider shorting or buying puts on QQQ or XLK, the tech sector ETF. All right. I have to say, as far as this is concerned, it's pretty good. I would not do one. That's for sure. I might do number two. I might do a combination. If I had to, I would probably do a combination of 2 and 4. So I'd collar it, but not just with puts. I'd probably use a put spread, and then it'd be nice to be able to sell the calls to defray the cost of the put spread. But you got to remember that the put spread is going to cost less than buying outright puts. So it would most likely be possible, you could probably do this, a combination of 2 and 4, put spread and a collar strategy, in which you purchase a put spread, but you don't sell all the calls. So you keep some in the chamber, and you can fire away when and if needed. But otherwise, I would not do this because it's going to be a little too broad for just one stock. If you inherited several stocks or a portfolio with a fair number of stocks in them, then this could make more sense. But then you'd have to go through the composition of the portfolio to understand what would be a good way to hedge it. And by that I mean, maybe you want to go with the Qs over the SPY, or maybe you want to go with the SPY over the Qs. IWM, possibly the diamonds, or maybe a tech sector or two. But overall, this advice is pretty good, and it's definitely much, much better than creating a synthetic straddle, which it got completely wrong. All right. Interesting. Chatgpt AI is getting better at this, and I imagine that in the near future, it will only get considerably better. However, if you don't understand the risk and you don't understand what's going on, and you just blindly follow what it says to do or what it suggests, you could get yourself in a whole lot of expensive trouble. All right. Thank you for tuning in, guys. We've got a few hours until the market opens. Sunday afternoon. Looks like it's about 12:30ish. 12:40. 20 of 1. A little more than 2 hours. And the fun begins. Catch you guys next time. Thanks for watching.